You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for a little program I like to call around these parts Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs for you guys to sink your teeth into, including many great archive episodes of this fine program. The Volatility Views, the easiest place to find all of that probably is our website, theoptionsinsider.com. You see the call out there on the right-hand side of the homepage. Just choose your program, hit go, and you're off to the races. You get the full archives there. You can also go iTunes, TuneIn, and Stitcher. Some of those don't always have the full archives. They may limit you to the most recent 50 or 100, which sounds like a lot, but in this case of this show and a lot of our shows, we have quite a few episodes. So if you want to get the full kit and caboodle, the website or our app available via iOS, Android, and the beloved Fire OS, probably the two easiest ways to get all that. If you grab the app, you can also hit us up via social media. It's all baked in there via email, all the fun ways. And of course, we'd love to see you guys who can join us live every Friday, noon Central, 1 p.m. Eastern via Mixlr, MIXLR. Stay tuned to our social media. We always tweet that out, just add options. You can find us there. Grab that link, bookmark it, save it, whatever you want to do, because we use the same link for all of our shows all week long. So once you grab it once, you're good to go. Or you can follow us over there in the Mixlr platform if you don't mind having one more account to your name. It is free, of course, and then you'll get notified whenever we go live. And then you too can join the fun party that is our live stream. And joining me on the old program today, let's start off, I think I know where everybody is, so I think we'll go in order of proximity, even though I don't know where the meatball is. Maybe we'll start with him. Mr. Greasy Meatball, Mark Sebastian from OptionPit.com by way of Carmen Line Capital. Mr. Meatball, welcome back to the program, and where are you beaming in from today, sir?
I am coming in from our global headquarters in downtown Chicago, and I am excited and been looking forward to this show all week. We saw a couple of really cool trades, so I've got plenty to talk about today.
I don't know what you're talking about. It's been a very quiet week for VIX. Not a lot going on at all. There's no real premium out there from a volatility perspective. Nothing really to sink our teeth into. In fact, I think we should just end the show right now. What do you think?
Correct. I agree, and yeah. Why don't just you and I move on to talking about silly things, and then and we'll just ignore the guest and Russell.
That's what we'll do. We'll just talk about silly things for an hour. Call the show Silly Things Views. Before we get to that, let's bring on another silly thing in the form of my other cohort here beaming in from now his corner office. See, I said it and I made it so. It's like The Secret. We visualized it here on the program and it happened. Now he does have that palatial corner office over there at the CBOE. Current the head of education. I believe that title is changing sometime soon, so something else sometime soon. But you know him, you love him as the man over there at the Options Institute, Mr. Russell Rhodes. Russell, welcome back to the Volatility Views program, and glad to see you are indeed beaming in from somewhere domestic these days and not these far-flung volatility locales that you find yourselves in most shows.
Yeah, I'm home. It's kind of nice. I'm going to be home for 2 weeks talking to you guys. And then you and I, not together, so people don't start talking, are jetting off to California. And I'm hanging out in the corner office. I've yet to hang pictures yet, but I'm definitely getting myself settled in here. And as you mentioned, I will have my 5th different title in the 8 years I've been at CBOE, and we'll talk about that next week. So I'm not supposed to talk about that.
The business card printer is very busy over there in CBOE land.
I never even got cards for this
you never
job.
even got the last cards. There you go. So you're owed one set of cards. You'll get those cards next, of course. You'll get those cards next, and then we'll refer to you continually as the head of education while you are whatever your new title is, Grand Poobah, Major Domo, Archduke over there. All right, but that's not our full team, listeners. We have a great guest lined up, too. So without further ado, let's dive right on into our Volatility Viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody, that music means it's time for us to be joined by a guest. Yes, we like our guests here on the old Volatility Views program, and today's guest is a newcomer to the show and indeed to the network. He is Tobias Hexter, the co-CIO over there at True Partner Capital. Tobias, welcome to the Volatility Views program, and it's a pleasure to have you in studio today, sir.
Thank you very much, Mark.
And Tobias, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our listeners a little bit of an overview of your background in the volatility space and what the heck it is you guys do over there at True Partner Capital.
Okay, I'll try to keep it brief.
I've given you about 12 minutes. You can fill all of that if you like.
Okay. You might recognize the Dutch accent. I started as a pit trader over on the floor in Amsterdam, went to Chicago in 2004, where I ran the office for a firm called IMC, and then went to Hong Kong in 2008 when the world was falling apart. And in Hong Kong is where I started with a group of people our current venture, which is a volatility arbitrage hedge fund. So we got started in 2011-ish. And what we basically do is we trade, on a global book, we trade equity index derivatives. So that's a very short introduction.
I like that. Some of our other guests could learn from you, sir. That was very, very concise and to the point. But you mentioned, a lot of things to unpack there. Well, I think we'll start with the shift to Hong Kong. Hong Kong is known as the mecca for many things. As a mecca for international trade and for exports and a bunch of other things, political relations, a lot of things. It's not really known as a mecca for all things volatility trading. So what drew you over there? And why start a Vol Arb fund in Hong Kong? And we haven't really talked about on the show that much. What's the Hong Kong volatility trading scene really like over there? Are there a lot of funds over there really doing it? Were you guys kind of the odd ducks over there? What was it like over there in Hong Kong trading volatility?
Well, in the beginning, of course, when not my firm, but a lot of other Dutch ventured towards Asia, Hong Kong was a typical location to start. It's very expat easy. English is plainly spoken, and getting used to the new environment is relatively convenient. And in the end, why Hong Kong, why not Tokyo, why not Singapore, is you need a bridgehead to start in that region. Having said that, the Hong Kong volatility scene can be described as relatively small, especially given that, for example, a lot of the market-making firms they still trade Asia, but they have sort of retrenched to Australia, preferring to have your downtime on Bondi Beach as opposed to being stuck in Hong Kong. But the market's interesting. Typically Asian, as you might well be aware, a lot of the flows are driven from the structured product issuance. I've been there as a client of the banks myself, and I had the unfortunate accident to get into an options discussion with my account manager, and somehow they mentioned in my profile, I'm interested in structured products. up to the point that if my wife would come into a bank branch for her credit card, they would try to stuff her with Hong Kong dollar yen derivative or anything. And that's actually the business model you see a lot of the banks in Asia. Package structure, any kind of volatility product from your clients, and then that's offloaded into either the market or OTC. Markets itself are interesting. A lot of names that I've never heard of before, but were quite interesting trading on the single stock basis. And of course, your local Asian indices are quite nice. Your H-shares Hong Kong, which is a China proxy, Nikkei, Kospi, small underappreciated market, Taiwan, and you can still have your arms all the way stretched to Aussie.
And Mr. Rhodes, I believe I can see your ears perking up there.
We do our risk management conference in Hong Kong, or our Asian version of our risk management conference in Hong Kong every year. And one of the things that I didn't get a clear picture on, but I remember overhearing between sessions, was that one of the motivations behind setting up in Hong Kong is some really favorable tax treatment on profits. Is that, am I correct on that one?
Well, in general, I would say the tax environment in Hong Kong is quite favorable. There's just a flat tax rate of 15%, both on the corporate level as on the individual level. Do mind you that the balance you will pay in your real estate, but overall the circumstances with regards to taxation are quite favorable in Hong Kong.
And, you mentioned some of the products over there. Let's break that down a little bit, because obviously you didn't go to Hong Kong primarily to trade VIX. You can certainly do that over there. But so you mentioned some of the products you were out there. Were you trying to trade and get exposure to a lot of, let's say, mainland Chinese vol or other other Asian instruments out there? What was your tool of choice over there, and how were you doing it? Were you using some sort of volatility product over there? The much maligned structured products that you mentioned earlier? Were you doing, hedge straddles, OTC variance swaps? What exactly were you slinging over there in Hong Kong to trade volatility?
Well, we have very much a market maker background. So that means that we trade everything listed. So that means the products of choice would be your Nikkei, your Kospi, your H-shares, your Hang Seng, your TAIEX, your Aussie, and just the main listed products. Mainland China is a bit of a tough one. It's from the outside a fantastic market, but of course they've really fenced it off. So the exposure you could get, there's a couple of ETFs called 2822 and 2823. All the company tickers in Hong Kong are numbers. And most of the structured product flow that's China related towards the A50 index actually is structured or is offloaded in a way also through these products. So there's decent liquidity, and that's the best proxy you get for mainland China. From an option perspective. Okay. Stock-wise, they're opening up the markets.
Yeah, it must have been interesting to go there in 2008, too. Obviously, tumultuous times here, also tumultuous times over there. An interesting time to break into a new market, I think, to put it mildly. And so it sounds like you were doing a lot of effectively hedge straddles as your vol arb tool of choice, and trading volatility that way as opposed to some sort of volatility, purposeful product in that sense.
Yeah, true. And the interesting part of indeed coming to Asia is that already 2007, the markets were quite interesting, because at that time there was this rumor called the through train, which means at that time unfettered access between Chinese equity markets and Hong Kong equity markets. At the time, Chinese valuations were relatively ridiculous, which means that as soon as this rumor would hit, you would get an explosion upwards in your H-shares and the Hang Seng. So when I came to Hong Kong, then you saw the most aggressive, positive upside skew I've ever seen. It's more reminiscent of what you saw here in the pre-2000 dot-com crisis in your tech names.
Interesting, because I think of aggressive upside skew. I think of, a few years back in the Apple time when everyone had to have Apple, they're just buying calls all day long, and the skew was pretty much a straight vertical line. You're saying you saw something similar to that over there in that time frame as well. It must have been an interesting time to be trading volatility out there. Obviously, a skew shape like that affords a few opportunities you don't get in your traditional investment skew out there.
Yeah, true. And what I like best about the 2008 period is that you had the local H-shares index at one point traded way over 100 vol, which was actually cheap because it moved even in excess of that. But I always like the concept that there's still a percentage, something relation where this all comes from. So an over 100% vol is always interesting from a theoretical perspective. But that was the extent of movement you had there.
Yeah, they're different beasts. I'm sure a lot of our listeners probably aren't even that familiar with a lot of the products you trade. I mean, Nikkei, but they're obviously familiar with, but a lot of the other ones probably not. So was it a similar setup? You mentioned kind of the skew being a little bit aberrant in that one case. A lot of our listeners are used to most of the products they deal with over here, the big indexes and equity options, having primarily an investment skew, so obviously a discount to the calls, a premium to the puts. Was that a similar setup over there? Were some of the names over there you were trading, it sounded like that one name in particular had a bit of an aberrant skew. Was that a common phenomenon over there? Were products kind of trading in a willy-nilly volatility skew fashion, or was it really kind of similar to what we see over here from a lot of the product perspective and a volatility perspective?
Yeah, everything related to China had that upside smile, or upside skew, depending how you call it. Other markets also depend on the circumstance. When 2011, 2012, the Japanese started their massive inflation or their massive quantitative easing, you also saw the same thing. At that point, expectations were such that it pushed your Nikkei higher strikes to a higher level. In general, market participants are somewhat different over there. For example, if you look at Hong Kong again, but you see it also in other markets, there's a very active warrant trading, which is very retail. And the cliche, and it's in a way an offensive cliche, but people in Asia tend to enjoy gambling. Given that there are relatively limited official venues, you saw in Kospi in the past and you saw in Hong Kong that a lot of people were punting in the market, either directly or through the use of warrants. The warrants were issued by the banks, and their business model, of course, is you issue the warrants at a steep premium, that's your profit, and just you need to make a semblance of an aftermarket. And what you notice is that when stocks started to rise, the banks will get lifted on their warrants, and at one point I almost had the feeling that a bell went off. The trader woke up from his coma, looked at his book and had started hedging. And then you saw these vol pops going up or even those spikes in the stock itself. So you tend to see a slightly different vol spot dynamic in Asia.
Now, you've heard of that before. A lot of people who play over there in Asia, that you're right, the warrant scene is much more vibrant than we have here, partly because they don't really have the same vibrant listed options scene that we have here. If you have that, warrants become a little bit, unnecessary. You can do most of that with options. I've often joked about warrants. It's kind of a bit of a poor man's option, but they serve a lot of the same functionality. But it's interesting the point you also bring up, too, about the let's say the proclivity to gambling in that culture over there, because that's one of the reasons we've heard quite a bit from people we've had on the network and talking to them about one of the reasons the government over there has been so hesitant, in the mainland China to really embrace options as a listed vehicle. They've pumped the brakes many times. They've only really trickled out one or a handful of listings over there to kind of test the waters. And we've heard all kinds of stories about them implementing, all sorts of draconian measures to keep retail out, like multipliers of 100,000 or crazy things that, no one can afford, no retail person could ever afford to buy even a one lot, because they were so terrified of that culture, like you mentioned. So is that, obviously you're back here in Chicago now, but is that something you think was really a big driver? Do you agree with that? That's kind of one of the reasons that we still haven't seen a lot of options being embraced over there by the government in China, is because there are concerns, maybe they have this misperception, a lot of people here do as well, that options are risky, so they're afraid that the retail public will just embrace them, and probably for the wrong use case, and that's why they're kind of pumping the brakes over there?
Yeah, they really learned the hard way. In 2007, they had a pilot with warrants, which indeed I fully agree are poor man's options. And they also had put warrants on some of the local Chinese banks. And they were massively popular. Both the calls and the puts went up in value, up to the point that your 5 yuan put on ICBC trades at 7.5. And not just one, but literally hundreds of thousands of contracts. So that, of course, ended in tears. Now, fast forward, they had a pilot with the A50 options that was there also during the meltdown in 2015. And of course, before that, there was a just as aggressive melt up in the Chinese markets. And at one point, when the market started to go down, the Chinese government wanted to avoid the market going down. So you saw people getting strong-armed into disabling people to short sell, disabling people to sell future, overnight suddenly doubling your margins. And options, of course, at one point were the only go-to tool, it looked, that people could get short exposure. So people would just simply buy the put and sell the call. And that's one of the reasons that also the Chinese government is relatively hesitant, because it is in a market where they don't want it to go down and are able to take extreme measures. A sidestep, if you look at volume of the CSI future, that went down like 99% over this clampdown. If they're willing to take extreme measures, then they are not that interested to have yet another instrument they need to clamp down on because it can give you short exposure. The interesting part, if you look in Asia, is that you saw it in Korea. Korea, of course, the won is a very tiny currency. There's about 1,200 won that go into one US. And they used to have small contract sizes in the Kospi, like 100,000 won. And these were massively popular. At that time, Kospi was about the most traded index product in the world. But they wanted retail participation out, so they changed the contract size to 500,000. And that shook out a lot of traders, made the whole index less interesting.
Yeah, I agree. For a long time, you're right. Kospi was this kind of shining star in Asia. It was a small contract size, had a lot of flow, including a lot of retail flow. So it was an interesting product to watch. And you're right, when they start messing with the multipliers, maybe in a similar mindset to what that misguided principle they have in China as well of pump the brakes for retail, it kind of ends up hurting the product at the end of the day. Well, obviously you're not in Hong Kong anymore. You're in the studios here with us, so you're obviously here in Chicago. What brought you to Chicago, and what are you guys trading over there? Is it a similar setup at True Capital? Are you trading similar stuff? Are you focusing mostly on domestic volatility? What are you guys trading now?
Well, what we did from Hong Kong was trade the world. So that means that we also traded Europe and Chicago, or at least the US. And that made for a relatively annoying trading day. So if you had the graveyard shift, that would be a 4 or 5 a.m. stop. So at one point, we envisioned that we would like to have a US presence as well. Given that I was in Chicago, and given that Chicago remains the option capital of this country, Chicago is a logical place to get started. So I'm really, really happy to come back here to set up our Chicago office. So now we can manage the world while seeing daylight and having a bit of social life.
You can live. I like that. Not be on the volatility graveyard shift. And you guys, similar thing. You're trading essentially, effectively hedge straddles on a variety of listed products. So you're getting into, there's obviously a more vibrant listed volatility product structure here. Are you getting into that as well? The futures, the options, the ETPs. Have you expanded your purview at all? Anything else you guys are trading over there?
Yeah, so we look at everything that's listed volatility-wise, but I'd say predominantly we would be look at your S&P stuff, look at your other indices, some single stock volatility, look at your VIX and the complex, and we usually just wave at the VXX while it slowly shrinks over time. It's not necessarily a product we really dabble in.
I like it. You're going to fit right in here on the show. We malign VIX, or VXX, I should say, on a very, very frequent basis. That's a lot of good. I think we covered a lot of interesting ground. We can keep going. But I know you want to join us on the rest of the show as well. So I think with that, we're going to dive right on into your brave man, Tobias. I like it. You're going to see very quickly. We're going to dive right on into our volatility review segment.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
We always love to have the more the merrier here on the Volatility Review program, of course, or Volatility Review segment, I should say. This is, of course, a segment of the show where we break down the week that was and indeed still is from volatility trading and analysis and trending and research perspective. Again, we're streaming this live here on Friday the 24th, right around the middle of the trading session, and it's a bit of a down day on the old street. Most of the major indices off fractionally on the day. Nothing really to write home about a 0.25%, pretty much across the board. That includes ye old VIX Cash, which is hovering right around the 11, almost unched exactly from where it was this time last week when we were doing the show. So if you had in the crystal ball literally unched, you were doing all right, if not so much. But an interesting week. I think we'll get into a lot of that stuff. Volatility-wise, also not the most rock'em sock'em robots of weeks, with VVIX hovering around still in that low 80s range as we're talking. Actually a little bit higher today, right? Close to 85 or so now. Was flirting with the low 80s earlier in the session here, and interesting stuff pretty much across the board. Maybe we'll start with you, Mr. Greasy Meatball, because I know there's a lot that's been catching your eye this week. What has been catching your eye over there in the land of Carmen line from a volatility perspective this week?
I think the big thing we've been watching is and this has been kind of a big story kind of around the volatility sector, is that VIX and SPX don't seem to be negatively correlating very much right now. They appear to actually have almost no correlation. A really nice rally in the March future. Went from about a low about 12.5 all the way back up to now 13.5 That meanwhile, the April future has kind of normalized. It's not nearly as expensive. Still overpriced. 1540 overpriced. But it's expensive. I would also note, look at that they just listed the March 29 future, and there is a big hitch in the curve between the March 22nd contract and the March 29 contract and the April 19 contract. I mean, one could make an argument that there is a very interesting futures spread between long March, short March 29, long April. So there's some really interesting stuff going on there. There's also been some relatively large option spreads that we've seen that have really been indicative of the spread that we've seen, the March versus April trade. So that's really what's caught me. The other piece on the oil front is the total lack of volatility in oil. It's doing nothing. So those are kind of the two major pieces that I really saw was, there is some really weird stuff going on with the VIX futures curve. VIX isn't correlating the S&P, and oil vol is way too expensive.
Yeah, there's a lot to unpack there. It has been an interesting week, I think, to put it mildly. Mr. Corner Office, we'll turn to you now. A lot to unpack there. People wringing their hands about how low the VIX is. People wringing their hands about how steep the VIX futures term structure is, and all sorts of other things. They're wringing their hands about the lack of correlation. What was catching your eye this week from a volatility perspective, sir?
Man, they're wringing their hands about France. That's what it's all about.
The Frexit, as our listener puts out in a little bit later on.
Oh, they called it Frexit.
That's what our listener does anyway. I like that.
I haven't gotten that far yet. But today's close we're going to switch from VIX to V stocks for a second. V stocks closed at 1585 today. The March futures are at 1755, and the April futures are at 2750. 10 points. And I think some of that, if you're worried about whatever's going to happen in April in France, and you look at that term structure, and then you look at our term structure, you're probably going to take a look at doing something with VIX instead of V stocks, because if one goes a little bonkers, the other one's going to go a little bit bonkers. So
yeah, but Russell, why are they? My question is the election's actually after April. It's April 23rd, I believe. Why is the March 29 contract where the hitch is? Is that because that's within 30 days of April 23? Is that the way they're thinking about it?
Because the April futures they actually expire before the April election.
Right. So you would think
the April V stocks does. But I think that's what it is they think it's going to keep creeping into the options the closer we get to the election.
Well, then shouldn't we see
being discounted here, and it's being discounted there, and it's not being discounted here yet.
Shouldn't we see like a big hitch in May futures that we're not seeing then? Because
I don't think April's where it should be.
Correct. That's what I mean.
So that's the one that, and we've talked about before that April is typically the quietest of volatility months, for no rhyme or reason in my mind. But that this year might change that depending on what goes on over in Europe. So
are we just going to be following every poll? Because as I recall, Brexit.
That worked out well last time.
I want to look at what happened with Brexit here briefly. Let me pull up a chart of this. It's not like VIX took off into Brexit last year.
Well, that's because we didn't think that it was going to pass.
Yeah, if you remember, the polling going into Brexit was a similar scenario. There was a poll, I believe Brexit was on like a Wednesday or a Thursday. There's a poll on that Monday effectively saying, look, it's not going to happen. Everyone bought that hook, line, and sinker. They crushed the vol going into the event, which we all know. Long term worked out. In the near term, it was terrifying, and people probably blew out. But speaking of international vol, Tobias, you kind of like you're our international vol guy on the show today. What do you make of what we're just talking about here? A lot of things to unpack. The lack of correlation, usually negative these days, kind of not so much between VIX and SPX. Of course, the ever steepening VIX futures term structure, a bit of a mystery. Is it Frexit? What else is going on out there? I mean, we have realized vol somewhere around 5 to 6 in the S&P right now, and the futures are pricing in somewhere around a 10-point premium. So a lot, obviously, unpacking there. A lot of things going on. So what's your take? What is keeping you guys up at night? What's catching your eye over there these days at True Capital Partners, True Partner Capital? Excuse me.
Yeah, definitely, indeed. If you look at the V stocks, that must be France. I'm Dutch. Our elections won't matter that much, but maybe some people in the details look at it. And I think people just, as exactly pointed out, ever since Brexit, and especially here the local elections, people don't trust polls. People think there is a bit of a bias in them, that people prefer to say the outcome that the listener wants to hear. So that means that the sort of ugly outcomes tend to be underrepresented, which in this case would be Le Pen. So even if the polls would go towards the mainstream candidates, that would not necessarily be reflected in volatility coming off. So I think what you see in Eurostoxx, there's a lot of fear in Europe. Not that Marine Le Pen, when she wins the elections, is able to immediately pull France out of Europe, but it's going to make things very difficult. Over here on the US side, and you see that a bit globally, nothing happens. Everybody's waiting for a trigger, and up until that point, you're clocking 6 realized volatilities. So I can imagine that if you see people are willing or gutsy to sell the shorter term end of the curve because nothing's going to happen, right? But people are not prepared to make such a call over a longer date. And that, I think, explains or justifies why you see that steep term structure. And with the VIX overall at a low level, that's where you start to see if the market keeps on going up, your negative correlation goes away because the market doesn't believe anymore that we just keep on going to new at the money, higher share price, lower at the money volatility. At one point, that downside curve on the upside is not being appreciated anymore.
Yeah, it has been fascinating. We joked on the show in the past, Tobias, that kind of the answer to all volatility questions can be found lurking somewhere in that VIX Futures term structure. This week, that kind of is the case. It is a bit of a interesting puzzle to unpack there. You know, we've been talking about the discrepancy between the cash and the front month futures and the 2-month futures for a while. It's been kind of an evolving picture to watch, even evolving today. You know, that front month coming off a little bit, only about 1.5 handles between the cash and the front month now, whereas almost 2 coming in to the end of the day. Yesterday, about 3.5 points. So once you start creeping out there, like we said, that premium gets pretty steep, about 3.5 points for 2 months out versus the cash. So, and it gets steeper from there, which is kind of interesting. That said, a lot of people are still worried. According, at least, there was an interesting article out there in a lot of places, including, I believe, Bloomberg, that even the Fed is worried that volatility is too low. According to this piece out there in Bloomberg this week, that their Fed says the reduced volatility is inconsistent with uncertainty. They express concern that the low level of implied volatility in equity markets appeared inconsistent with the considerable uncertainty attending the outlook for Donald Trump to deliver on his pro-growth campaign policies. That's, of course, according to the Fed's meeting from 3 weeks ago. So, again, a bit of a lagging indicator. They probably are even more concerned now if they were concerned 3 weeks ago about where volatility was. But still, interesting stuff. I don't know. I'm sure, Russell, you guys over there at the CBOE are getting hit up about this left, right, and center. Are you buying into this? This seems to be yet another variation on, is the VIX too low? Why is the VIX too low? We seem to get this a lot whenever VIX Cash drifts south of the 12 handle. That's when that drum beat really seems to start getting aggressive. Are you hearing a lot of this over there in CBOE land? And what is your take on this new flavor of it, which is it's the Fed that's scared about low vol?
Well, of course I'm hearing this. This is my job, people, to talk about VIX. But, you know, VIX has been low. We've had very low realized volatility, in conjunction with this and after the low VIX, and we keep grinding higher. So, you know, if you pay attention to VIX being low, indicating there's not a lot of concern about the markets, hey, it's been right. And every time that this comes around where we have a relatively low period of implied vol and realized volatility, is VIX not telling us the same things anymore. VIX is, it's just a statistical calculation, and the statistical calculation is basically telling you that there ain't a whole lot of fear in the market, and so far it's been justified.
Yeah, Russell, I tend to agree. I don't think that, a low VIX necessarily really means much. Now, the price action this week that we talked about earlier, where that the correlation is kind of breaking, that can mean something.
Mm-hmm.
But if you look, the one thing that has failed to accompany this kind of weird change in correlation, normally I would expect that to be associated with a bid in VVIX, seeing demand for vol start to increase and maybe make a run at 90 and 95. But we've seen the vol, the demand for VIX options, stay relatively flat. Not a lot of demand either way. I mean, there's plenty of trading, but nothing really, no really one-sided order flow that's pulling VIX so much higher. So there's something there. My argument at the beginning of the week, I put out a research note through Tullet Prebon was, if you're worried, we're at all-time highs, and you get to hedge with a VVIX at 80, and vol futures that aren't that expensive on a relative term. So if you're concerned, hedge. I certainly wouldn't be going to cash here, because we could MAGA our way right all the way up to 24.5 before all is said and done.
So you mentioned that whenever you throw something out there, and I have a couple of minutes to play with numbers, I play with numbers, and you mentioned the lack of correlation right now. So I calculated the rolling 30-day correlation between the percent change in VIX and the percent change in in the S&P 500, and the range from 1990 to present is a low of minus 0.96. And actually, we had a 30-day period in the past where the correlation between VIX and the S&P 500 was positive 0.35. I was shocked to see a positive number.
I was too. Wow.
Yeah, I know. I love it when the numbers surprise me. And if I made a mistake, we're going to erase this part, right?
Yeah. Well, yeah. I'll be interested.
No, I didn't make a mistake. Trust me, because
it must be true.
What was the forward return? I'd be interested in what the return was after that correlation happened.
I'm on that, man. But you got me started on this one. We've actually within, and this goes all the way back to 1990, and sometimes those older VIX numbers kind of get in there and muck things up. But the chart of all of this. And most of the positive correlations were in the early 90s. The chart of all of this looks it looks pretty consistent with a range since 2000 of minus 0.4 and minus 0.9. It's interesting to watch. I've never looked at this before, so it's one of the reasons I like doing this show. It gives me more stuff to play around with.
We get a surprising insight into Russell's personal life now. He has any downtime, he immediately breaks out VIX SPX correlation tables. That's an evening in the Rhodes house. But Tobias, I can see you chomping the bit here. There's obviously a lot to unpack here. We're just talking about that, of course, with surprising little flirtations of positive correlation between VIX and SPX, as well as what's going on here in the volatility space. So what are your thoughts on everything we were just talking about there?
I just had to laugh at the Fed thinking that the VIX is too low, given that the reason that the VIX is trading at these levels and that so many people are comfortable with trades like the XIV ETF, which is like retail selling VIX, is that it's the same Fed and their central bank friends across the world who are able to step in as soon as the VIX even remotely sniffs 20. And the interesting part is that we've had this now for about 5 years, ever since Draghi went all in. And what you see is that people start to have a knee-jerk that when the VIX hits a 20 handle, it's a short. And actually, it has worked out. And even the guys on CNBC started calling it from the perspective, if there's a market dip, you should buy. What is interesting is that a lot of people trade on algos or other history. The French love their Monte Carlo simulations. So we now have 5 years in which normal is perceived as a situation where there is a total cap on the VIX and where central banks step in. So that is ingrained in the memory of your collective traders or risk managers. It sneaks its way into your 3-year VAR calculations. So what I think is that there will be a point, maybe this year, and with the current president in charge over in the US, the likelihood of something happening has increased. There will be a point where if the central banks don't step in or the magnitude is bigger than people expected, the people who knee-jerkingly say 20 VIX is a sell because that's what it was the past 5 years are going to get absolutely smoked. So from that perspective, it's almost like a tranquility because the situation now assumes you're backing, implicit or not, from central banks that nothing will happen. And when that carpet gets pushed away, a lot of people are going to caught by something that they just don't remember or could fathom. And then, of course, we're going to shout it's a Six Sigma again.
Six Sigmas every few months, it seems like, or at least talking about it, the fear over them. Speaking of fear, we're all afraid of Russell's segment, yet we do it anyway. It's time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
All right, everybody, it's time for the man in the corner office to hold court for 15 to 18 minutes, I would say, about all of the myriad activity. It actually wasn't a decent week out there in weekly VIX options, Lance. Mr. Rhodes, put down your correlation pencil, pick up your weekly VIX options pencil, and what caught your eye this week, sir?
I'm trying to finish my chart. All right, there a few things did happen in the weeklies. Today, I saw somebody buying several lots of the March 1st 12 calls, paying 90 cents for those. It looked like they bought 2,000 or 3,000. Then somebody else, and I'm pretty sure this is just by the nature of the volume, it looks like somebody was buying puts, and it was a different trader, bought 2,000 of the 12.5 puts for 40 cents. They divided that up among 4 of the market makers. Somebody that today also has been selling naked a little under 200 of the 16 calls that expire on March 8th and taking in 35 cents for those. And then probably the most interesting weekly trade, and you think that I only pay attention to all of this when I'm talking to you guys, but on Tuesday, somebody came in and sold 100 of the March 14th, and those of you that have the ability to visualize calendars in their minds, March 14th is a Tuesday. That's due to the Good Friday holiday. We've got a Tuesday VIX expiration coming up in about 3 weeks. They bought 100 of the they sold 100 of the March 14th 15 strike calls for 60 cents. And then they bought 100 of the May 20 calls for $1.16. And I wonder if that's a program where somebody's gonna, sell more calls as we go along and have some protection against any sort of volatility spike. Usually when you see a calendar or a diagonal spread like that, you think maybe they're just trying to lower the cost of the longer dated options. But using the March 14th, I think they're probably going to do that and let those expire if things work out for them, and then continue to roll out forward. And then on Tuesday, a really interesting trade. And I think somebody took advantage of, as Mark Sebastian put it, some sort of kink in the curve. But somebody sold 3,000 of the March 8th 13 puts for $1.10, and they bought 3,000 of the March 14th 13 puts for $1.05. So they actually got a 5-cent credit on that trade, and I thought that one was somewhat interesting.
Yeah, that's a lot of funky time spreads, the order of the day this week in the weeklies. I do like the other one you mentioned in that call calendar kind of as well, because you're right. You see that at first blush. You think he's financing the longer term one, but there could be, especially when you're getting that aggressive. You don't usually write that aggressive of a call to finance that, because then you're taking a little bit more risk in the near term than maybe you could be comfortable with. So that's an interesting one to watch. I have a feeling our friend out there is up to perhaps a little bit more than he appears. So we'll keep an eye on that one. Only 100 lot, but sometimes not just the size, it's the structure that is interesting as well. Speaking of size, it was a pretty active week overall, not as rock'em sock'em robots as last week from a VIX options perspective, but still pretty active. The ADV creeping up to about 575 now, so flirting back with that 600,000 contract level again. Hasn't hit it yet, but getting closer again, a sign that the volume is slowly returning. Most of the week pretty aggressive. We had Thursday about 783,000, Wednesday right around 500,000, and then Tuesday 719, of course. Monday 0. We were closed here for the President's Day holiday in the States, about 2.6 to 1 calls over puts, so pretty light here from the call-heavy perspective. Getting back to what Russell was saying earlier, and we've said on the show many times, puts kind of active right now. In fact, looking at the hot strikes, this may be the first. I'll have to go back and check it. I'm not sure if this is the first time. If it's one of the few times that we've had a put topping our top 10 hot strikes list this week, listeners. It's the March 12 put, number one with the bullet, 321,000 contracts out there. So puts taking the charge, and that's it for the rest of the chart. No other puts available, but the March 12 puts taking enough for everybody else, I guess. Number 2, the March 17s, which 305,000 contracts. Number 3, the April 20s with about 289,000. Number 4, March 16s. what Russell was just referring to, his favorite strike out there, 287,000 contracts open. Then we drop off a bit to number 5, the 825s, 239,000. Then the March 18s, a little more aggressive here, 224,000 contracts. The March call strip for the rest of the thing, except for April 1 at the end here. March 23s, 213. Number 8, the March 21s, just a tick under 200,000, almost equal to the March 20s, about the same number open on both, 199 and change. And then number 10 on our list, bringing up the rear, the 821s with 195,000 a total. Pretty aggressive, outstanding open interest, about 8.6 million, about 6.2 on the calls, about 2.4 on the puts. Before we move off this really quickly, Tobias, I'd like to ask this of all of our guests. A notable exception on this list, and it has been for the last couple of weeks, because usually when we do this hot strikes list, I don't care where it is, I don't care what time it is, I don't care where the VIX is trading, Tobias, there's always a 30 strike on this list. I don't care what month. People have they're just enraptured with the 30 strike. This is one of the few weeks that it isn't. I'm sure if we dug down to the top 15, it would be in there. I'm curious if you have a thought on, this week notwithstanding, why the 30s captures the imagination of, is it just that's the line that the actuaries have determined is a good break point where they have to be long, they cover some of their short vega at that point for insurance companies? Why do you think the 30 strike has captured the imagination of so many people out there?
Yeah, it's interesting. It might indeed be something VAR-driven that in any of the risk models that the guys apply, there's one scenario in which the VIX pops straight past 30, and then you buy the cheapest one out there, but you don't want to look so embarrassing that you buy like a 40. So it's maybe that's the first really cheap one out there. Maybe it's wishful thinking. It's just nice to have a VIX with a 3 handle. I think all the Vol guys would love that.
I like that notion. It's too embarrassing to buy the 40s. That's crazy. 30s, even when VIX is 11, 12, that's okay. But 40s, that's when you get the tapped on the shoulder saying, "What the heck are you doing?" I like that. Maybe there is something to that. The 30s, the least embarrassing of the outrageous VIX hedges. I like that. I might have to go with that going forward. Assuming we see the 30s again, they've recently been off our list. So after I started asking this question, it went away. So maybe someone realized we're onto them out there in the volatility space, and they were embarrassed themselves, and they decided not to do it. Really quickly, it was there were still some earnings popping off this week. Oh, before we get to that, Mark, I know you had some VIX options activity that was catching your eye out there. So really quickly, what was catching your eye out there in the mothership of VIX options this week?
Yeah, there was the big trade that went up today. Traders sold 108,000 of the March 17 calls, bought 108,000 of the April 21 calls, paying 42 cents. That trade sounds extremely familiar. I'm wondering whether that was a close. But the guy paid 42 cents on that trade. But that was one of the big trade du jours that went up this today. A couple other things, a big March 18 call buyer, and this one in particular was interesting. We had a big seller. I think he sold about 5,000 of the March 12.5, 15 strangles at $1.33. So somebody that's saying, hey, maybe the futures are kind of done here for a little bit. So those were the big trades I was seeing. I'm now been inspired though to play around with some short put time spreads that I might play with here. So maybe we'll have some fun things to talk about next
I thought you were going to say
week.
I was inspired to blast out some strangles. I was like, oh, interesting. But
No, I'm not.
that doesn't sound like you, but you never know. You never know when inspiration may strike. We don't see a lot of a lot of strangle sellers out here in VIX, unless we get in some of these weird times like now where you can maybe argue things are a little bit extravagant. But then again, we don't know what the heck the future holds. So it is an interesting time to be blasting out all that volatility. Speaking of volatility, really quick here, Mr. Rhodes, I know you like to look at all things domestic and earnings. You're a big earnings junkie, cranking away your earnings straddles. There still were a few big names popping off this week. It seemed like our theme mostly held intact with a handful of exceptions out there, like everyone's favorite name / whipping boy, of course, Tesla. They were pricing in about 6%, which is actually relatively calm and quiet for them, all things considered. They were trading around $273 when they went into their earnings. They're pricing in about $17. They opened up down about 3.5%, but by the end of the day, they were down about a little over 6%. So one of the few names that actually met or exceeded its straddle in this earnings period. Fitbit, one of the another underperforming underperformer. They're pricing in an impressive 13% for a cheap stock, about almost $6, and they were opened up effectively, unched the next day, so not a lot of love there from a vol perspective. Walmart, they're pricing in, they're closed about $69 and change. They're pricing in about 2.25, so a little over 3%. They ended up moving right around a little bit less than $2 on the open. By the end of the day, they had moved over 4%. So again, one of the few names that actually outperformed. But are you still of the opinion, Mr. Rhodes, that it's been kind of a resounding meh from a earnings volatility standpoint this season?
Yeah, it's been a resounding meh just based on what the straddles were pricing into the earnings announcements. The average move for Fitbit is about 18%. And you said it was pricing in 13%. And the average 3-year move for Tesla, where is Tesla on my list? It's a long list. Was 5.75%. And you said it was pricing in less than that as well, I believe. So, or was Tesla pricing in a little bit more?
Tesla was pricing in, let me see, they're pricing in 6%.
Okay, so they were pricing in basically in line, even though the stocks had about 11% moves in both directions. So I think what you're actually starting to see, and don't take this as we've got cheap ways to play earnings because the realized volatility after earnings is justifying this, but we're seeing some really cheap, the fact that we don't see the blow-ups to the upside or the downside around earnings is lowering the volatility on the straddles going into earnings because everybody is probably taking advantage of earnings volatility and trying to benefit from the volatility crush. And as long as that works, they'll probably keep doing it.
Yeah, I do kind of wonder if we do have this resounding underperformance this time. People have short memories in the volatility space. They'll price next quarter like a little bit less because of this quarter, then everyone will outperform, and then we have this weird song and dance again. Speaking of song and dance, time for you guys to get involved and check in with our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. Like the man said, this is the portion of the show where you guys get to join us. A lot of you guys hitting us up with crazy questions today, including some appropriate ones. We kind of touched on this already, but we got it from FKSTH, a bunch of consonants. He wants to know, hey, he sent us an interesting chart here, actually, of V stocks versus VIX. He said, is this Frexit risk? So I wanted to bring it up just because I like that term. We haven't seen that bandied about that too much yet. It's not as prominent as Brexit. I'm sure it'll get out there soon. But your view on this on today's show would be very interesting. We kind of touched on this a little bit already. Kind of the, I think Tobias, you kind of touched on this as well, that, V stocks and Russell as well. V stocks, maybe not the best place to play that right now. Actually, you think VIX. What are your thoughts here on maybe the current disassociation we're seeing between VIX and V stocks, and right now, if people are interested or concerned about this quote unquote Frexit, where would you be playing this? Would you be playing it domestically with the VIX? Would you be playing it internationally or more European bent with the V stocks? What's your product of choice there?
I would say it's a European thing. So I think the impact to the US, even though it will be there, will be of a smaller magnitude than what you see within Europe. So it's a difficult one to dabble at because in the end nobody knows what's going to happen. But if people want to take a punt, which effectively is, then I would, even though it's very expensive, I would take the European product because that, if anything, where the movements will be. You're a bit sore if you have made the call correctly. You go to a peripheral product because it's slightly cheaper, and you don't get anything.
Yeah, it is interesting to see. I think he also has a corollary here. He wants to also know our thoughts. This is something we've had people writing in for the last couple of weeks. We haven't had a chance to address it. Maybe we'll get to it now in the scant handful of minutes we have, which is we're seeing a lot of people asking about including him, the asset managers being record net short VIX futures. They're seeing a heavy bias towards that these days. That shouldn't come as a surprise if you've been listening to any of the options activity we've been outlining out here. It's puts, and of course some short upside trades as well. So a lot of people are out there using whatever they can to get short some vol, including the VIX Futures, so it shouldn't really surprise us. But I don't know, Mark, what are your thoughts here these days on, as our listener terms it, record numbers of asset managers being net short VIX Futures?
I mean, record numbers. Well, of course they're record numbers because it's an it's an up and coming product where a lot of people are getting into it. That can be a crowded space, but I don't think it's the end of the. I don't think that necessarily means anything. A lot of these guys set up hedges. They do all sorts of other things. So that would be something to think about. That's my thoughts.
Speaking of things to think about, really quickly, I want to get your take on this. This one has been lighting it up with our Twitterverse. We love to ask the Twitter questions, and this week we asked everybody. We know everyone's got low VIX on the brain, so we said, hey, VIX has already hit single digits under Mr. Trump there. How low will it get during the rest of his term? And we gave them 4 choices. Tobias, you can weigh in on this as well. We said, will it not, so it won't break 10 again, so you don't think it'll hit single digits again. We have pretty much 4 years of talking about here, so it's a long time frame. Or will it get between 9 and 10? Will it get between 8 and 9? Or will it get below 8? This is an interesting one. Let's start with you, Mr. Rhodes. What is your vote, and what do you think is winning our poll?
Oh my gosh. I didn't even, I would think that the lowest expectation.
So you think below 8 is winning?
Yeah.
And that's your vote as well?
Yeah. You know why? No, I haven't voted yet because I haven't checked it. But you know why? So you'll stop talking about how high I guess everything.
There we go.
Actually, in reality, I would say between 9 and 10.
We had your cohort here, Mr. Meatball, on the option block here yesterday, make a vehement argument for how below 8 was not structurally or practically possible, which it led to an interesting debate, which I encourage your listeners to check out if they haven't done so yet on that program. But that said, Mr. Meatball, where do you vote? And what is your vote, and what do you think is winning the poll?
I'm going to say 10 to 11. That's one of the categories, right?
No, I say single digits. So if you don't think it's going to break single digits again, you say it won't break 10. Otherwise,
I don't think it's going to break single digits. I just think there's enough demand that for options that's going to be real tough in today's environment. There's just you could see the aggregate of the 500 equities. You could see their aggregate implied volatilities break lows that we've never seen. But I think you have a hard time seeing VIX break 10 just because all these shops need to carry this stuff under Dodd-Frank. If Dodd-Frank changes, then maybe you could see single digits again. That's my feeling.
Well, we did just touch it ever so briefly, 9.97. We did touch it.
Well, trading. I don't.
That's all that matters. And for the purposes of our poll,
that doesn't count.
Aberrant prints can count ever so briefly, 9.97. Tobias, bring us home here. What are your thoughts? You think it won't break 10 again? You think it'll get between 9 and 10, between 8 and 9, or below 8? Where do you fall, sir? Then I'll reveal the results.
I would go for Make America Volatile again. I don't think we're going to touch it again.
Oh, well,
I do think the votes were mostly on the 8 to 9 part.
Interesting. And he's not cheating, listeners. He can't see my screen, even though it's turned. I've angled it to prevent any cheating. We know these Dutch volatility traders. They tend to peek. But it's been interesting to watch this voting, how it's been breaking down so far. And again, you got about another day or so if you haven't voted yet in our question of the week. And for a while there, it was all below 8, and now it's kind of become a little bit more even keel with a tie between below 8 and it won't break 10. Both of them at 27%, and then a second tie for second place with between 9 and 10 and between 8 and 9 at 23%. So effectively, our audience is split almost exactly 25% to each across the board. So if you don't agree with that, listeners, get in there and vote. You got another day or so at Options over there on Twitter to do just that. All right, it's time for our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, you guys know the drill. This is the portion of the show where we all predict recklessly, some may say wildly, the future of what volatility holds in store for us this week. And we went a little bit to the south, except for Mr. Rhodes. And Mr. Rhodes actually looking pretty good. If I can get everything's crashing on me over here, Mr. Rhodes. I don't have the exact. So why don't you guys do me the honors of telling me where VIX Cash is right now?
What was my guess?
You guessed 11.75. I'm guessing you're pretty close.
That's where it's at, man.
I was going to say, you always exactly on. Wow, well done, sir.
It's 11. It's actually 11. Oh, mine just crashed. 1170 was the last price I saw.
There we go. I've infected you with my crash bug through the Skype
no,
line.
The reason mine crashed is my intern just started using it. I told him he couldn't use it until 1.
There you go. Well, I give you pride. I guess he can't tell. Oh, I guess it is 1, so we need to wrap up anyway. But yeah, you get pride of place, getting one of your rare almost exacts on there, Mr. Rhodes. So you get the pride of place of either going first. I was a lot less. I was about 10.5, 10.45. Mr. Meatball was kind of splitting the difference here, 10.85 in between the two of us. Yeah, so no volatility downside for us this week. Mr. Rhodes winning. So you want to go first? Or you want to pick first, or you want to pick someone else?
I'm gonna go ahead and go first. I've just seen so much bullish activity in the March 1st and the March 8th that maybe there's just something I'm missing out there. So I am going to go high, and I got a reason for it. So I'm going to go 1234, 1, 2, 3, 4.
It is kind of hard to argue against 12.34. It's kind of hard to argue against that redonkulous bid that's getting out there into those futures. I mean, you start looking.
Yeah.
We're only going out a week, but still, it is starting to creep up. Mr. Meatball, you feeling that love as well? Or are you going to go south?
I'm gonna go. I'm gonna predict my book. So I'm going to say 11.5.
Shocking. All right, 11.5 for the Meatball. And Tobias, in case you haven't figured it out by now, this is the part of the show where we try to guess where VIX Cash will be exactly this time next week at the close of the show. So if you would be so bold, sir, what are you feeling this time next week?
Again, I'm not talking my book, just a personal opinion, but I'm actually going to go high. I'm going at 12.65.
12.65. A lot of guys feeling the love. It's kind of hard to argue against all that money out there, even though they're net short VIX futures. Look at the term structure; they're still bidding this thing up. Yeah, it's kind of hard to argue. Everyone's going north, so I think I will be the fun guy hanging out. We're at 11.75 now. Mark's down here too at 11.5 though. I thought otherwise I'd have it all to myself. All right then, so I got to give myself a little bit of distance here. Let's go. I don't want to go all the way down to 11. I'm going to go 11.25. So give Mark a little bit of wiggle room there, and I get all the south side, which I like because I can see the arguments for upside. You don't know Russell; he's been buying VIX for as long as the show has been running with him. So that's kind of his thing. But we'll see how it plays out. Unfortunately, though, Russell's intern is using his internet. That means it's time for us to come to a close with this epic episode of Volatility Views. There's our music. All right, but before we go, one last time, we go around the horn, checking each of my cohorts, my partners in crime, see what they have cooking. And Tobias, as our guest, you get pride of place. Give our listeners a bit of a glimpse, and if they like what you guys are working on over there in the land of all things true partner capital, and then if they like what they heard from you today, where can they reach out to you guys, and where can they find you?
We're just happily chugging along, looking at global vols. I don't know to what extent I'm actually allowed to give my contact information from a regulatory perspective.
Is there a website for your fund or anything along those lines they can go check out, or any material that they can see there? Twitter, Facebook, any of that fun stuff? How about this? Just search for True Partner Capital online and see what you find, listeners. If you can break the secret code, you too can learn more about True Capital. Thank you for Tobias for joining us in studio, and Mr. Rhodes, what's cooking in the land of all things live vol and CBOE?
We are, it's public knowledge, so I can talk about this. We expect to close our deal with BATS next week. So we will be a completely new organization when I talk to you guys in a week. The week after that, going down to California. And then after that, just a handful of spring and summer trips that they've got planned for me.
So next week, you'll be the head of education of CBOE BATS. CBATS.
No, I'll be CBATS. It's CBATS.
CBATS.
I like it.
There you go. We're giving him ideas. Speaking of the Mr. CBATS, Mr. Greasy Meatball, what's cooking in the land of Carmen Line and the Option Pit?
At Option Pit, we did I did a webinar last night, lifting off with condors and butterflies. If you want to learn Some good stuff about how to trade condors and butterflies. Go to optionpit.com/flies and scroll down a little bit. You can watch the whole replay. It's about an hour long, chock full of information. Go check it out.
There you go. Check it out over there, optionpit.com, to learn more. And on behalf of Mark and Mr. Rhodes and Tobias and indeed myself, I thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for all of you who joined us live, we love you guys too. If you're in the room, stay tuned, stay close, go grab a beverage, hit the restroom. Be back here in about 25 minutes. We're going to go live with Twifo. So if you missed all the commodity vol stuff we didn't have a chance to get to on this show, don't worry. We'll get to it on Twifo with our friends over there on CME. And we'll see you next time on this program for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.